Hello, everybody. Welcome to our second video. And if I didn't mention this before, the material we're going through is copyright Wiley 17th edition. Actually, this would be, I'm looking now at the 18th edition. This is problem 15.5 or 16.5 if you're looking the 17th edition. But let's go ahead and now take a look at fully diluted earnings per share or diluted earnings per share. So what exactly does diluted earnings per share mean? Well, we're going to start over here with our basic earnings per share. And if we have something that is in fact dilutive, what we're then going to be able to kind of go through and say is like, well, if the earnings per share drops from 1.425 below, then we're going to go through and include it in our earnings per share. Now, whenever we're looking at this, let's go ahead and take a look at our first item up for bids here. I'm going to go to the options next, but I'm going to start over here first with the bonds. Note the preferred stock. It does not say anything about how it is in fact convertible. It does not say convertible preferred stock, so that is not going to be a factor in our computation here for basically for this. When I look at the 8% convertible bonds payable, what I want to try to figure out are two things. If the bonds converted, right, how much interest could I have avoided? And also at the same time, too, how many shares would have been issued? So when we look at this over here, we've got 5 million worth of bonds. And this is going to go through and tell us that each bond was issued at face value. And it's per $1,000 bond, right? So basically we have 5 million in bonds. Each bond has basically as a face value of 1,000, which means we issued 5,000 bonds issued. Now, coming over here, we've got 5,000 bonds issued. And then it basically tells us that they will each turn into common stock of 50 shares. Okay, so when we look at this, we're going to be effectively issuing 250,000 shares of common stock. We've got 5,000 bonds. It's basically converting basically 50 shares of common stock per bond are the total shares issued. Now, when I first looked at this question, because it's been a while since I've done it, I kind of said, well, 5 million divided by 250 is $20 per share. And I kind of be saying to myself, well, hey, Bennett, if the market price is 20, why would you actually go through and convert? It's because when we go through and do this, if we assume the conversion, and this is really what's important, is we have to kind of go through and figure out how much interest are we going to be saving, like if these bonds went through and converted. So I would be adding to the denominator right over here, basically the bonds over here at 250,000. Now the question becomes, well, if these bonds in fact converted, how much interest would I have saved? So let's go through and figure this out. So the bond on the 8% convertible bonds payable, the amount of interest I would have been paying pre-tax, and this is what's really important. Remember, all of these numbers here are after tax. So when we come over here and look at this, we see that there was a tax rate of 20%. So what I need to go through and do is to basically say, well, what is this number after tax? So if there's a 20% tax rate, this will basically be the after-tax savings. So effectively, what I would be doing over here is I would be adding back 320,000. Now, so again, if the bonds would have converted since the very beginning, and that's what's really important about this, if those bonds in fact converted, I then essentially I wouldn't have had to pay the interest. So that interest would be added back to the net income minus those preferred dividends. However, in kind of going through and doing so, this is an after-tax number, especially with regards to the 1.5 million. So what I'm going to have to go through and do is to say, well, I would have saved my normal interest is at 400,000 or 5 million worth of bonds at 8%. There is a 20% tax rate or 400,000 times 20%, which gives me, when I subtract the 80,000, basically the tax effect, I would get down to 320. Now, here's the big trick. Is this dilutive? Well, if we take 320 divided by 350 divided by 250, we get 1.28. Because we would say that this is dilutive, because now if I was looking over here at my earnings per share, it's now $1.40, which is lower than the basic earnings per share I had before. So we would say that this is in fact dilutive. So because this is dilutive, we're going to go through and include it. Okay. So now the next thing we have to go through and deal with are the options. Now, if these options, right, I can buy 200,000 shares at $15 per share. And just give me one moment. Okay. So then the last part of this we're going to have to deal with are the options. Okay. So when it comes to basically going through and looking at stock options, the first thing we need to look at is the strike price or the exercise price, and then the market value. Okay. So my exercise price is 15. My market value was $20 per share. So would you want to exercise these options? The answer is yes. However, when it comes to this, what we're going to try to go through and figure out is like, well, what if we did something called a cashless exercise? Meaning that, well, what if we did not use cash to go through and to basically, figure out what these things were actually worth? So, and the reason why this is important is because, by the way, if the market value is 14, we ignore it because no one in their right mind would exercise options that are below market value. But in this case over here, the market value exceeds the exercise price, so we have to go through and deal with it. So the first thing we want to figure out is like, what would the proceeds be if the options were exercised? Okay, so over here we have options. There were 200,000 options. And again, the Wiley uses these crazy dates. They'll go July 1st. It's for a full year. If it wasn't the case, you would have to basically multiply it by 0.5, but it's what they do. My options were 200,000. And if I went through over here and I basically exercised them at $15 per share, the company would basically be receiving proceeds of essentially $3 million. So, and this is how many basically over here, you've got basically shares issued upon the exercise of options. Now, the real question becomes, is that of these, basically, if we were to go out and repurchase these shares on the open market at the current market price of 20, how many shares would this go through and amount to? Well, over here, if I spent $3 million, I would basically be able to buy shares at 20 per share. So essentially, shares repurchasable with the proceeds would be 150,000. Or if I got 3 million, I went out on the open market and spent $20 per share. This would leave me with roughly 150,000. So again, take 3 million at 20 per share. I could repurchase basically 150,000 shares. So effectively, my incremental or my additional or for fully diluted shares outstanding are going to be over here of 50,000. Again, a way I want you to kind of go through and think about this. You got 200,000 options, right? And well, like, that is in the money, right? These are in the money options. However, we could theoretically, if we got these proceeds or if we received 3 million, we could go out to the open market and repurchase them. So the actual value of those options or in terms of additional shares being issued would be 50,000. So over here, we have another 50,000 shares. Note, this is going to have no impact on basically on the net income, right? Because obviously over here, this is going to be fully dilutive, right? There's no proceeds coming in over here, would not impact net income. The interest did impact net income because we'd have to pay interest on those bonds. So my new fully diluted earnings per share is going to be the basic earnings per share plus the after-tax interest expense being added back. And then I'm over here, I'm adding the basic common shares outstanding plus the shares being issued as a result of the bond conversion plus the incremental shares as a result of the options going through and doing an as-if exercise. So my dilutive earnings per share is going to be $1.34 or that nice unround number. So for my viewer who requested this, I hope this helps. Thank you for liking and subscribing to the channel, and feel free to reach out to me if you have any other questions. Have a great day, and I'll see you soon.